house. Good morning, everyone. Welcome to the first session of the day. Unfortunately, we're missing a panelist who got a COVID recently, so she couldn't even get on the plane. But thank you for joining us this morning. We'll start with the introductions. So, shall we start with you, Zia?
Sure. My name's Zia Word. I am with Macroeconomic. So we call ourselves the Composable Fund. We're a Web3 fund and accelerator. And yeah, I've been in the space since 2015, so a while. And yeah, that's me.
All right, we'll continue with that. Brandon, please go ahead.
Hi, everyone. I don't know if this is working.
I can't hear you.
No, it's not.
No, can't hear you.
We have a technical problem in the Blockchain Week conference.
Oh, did this work? I think it's
yeah.
Hello. Okay, perfect. Hi, everyone. My name is Brandon, and I'm with Framework Ventures. We're an early-stage crypto fund focused predominantly across gaming, infrastructure, and DeFi, based out of the US.
I'm the principal of Swissborg Ventures, which is the investment arm of Swissborg, which is a crypto wealth management app licensed in Switzerland. And we're, as well as Framework Ventures, doing early-stage investments into the blockchain industry that are strategically aligned with our mother company, Swissborg.
I should have also introduced myself, by the way. I completely missed that part. I'm Pelin and Özalp, and I represent Akın Holding, which is an infrastructure holding in Turkey. But as the second generation, we're now moving into investing in alternative assets as well. So we've recently invested in 20 or so VC funds, and we do some pre-seed investments as well. And obviously, as the second generation, I feel like I have to. That's why I'm here. Okay, just moving on with the questions. Our panel is bear market. But before we move to that, Zia, what I read in your CV, it was fascinating. You said it takes more than money to build the future. So how does your future look like with Macroeconomic?
Yeah, so, okay. You know, when I say it takes more than money to build the future, right, having come from an entrepreneurial background myself, so when I say I've been in the space since 2015, I actually had a company in China in 2015. And we built that company for about 3.5 years, and we sold it in 2018. And it was funny, I was having conversations last night about, you know, that's pretty early in the blockchain space to have built and sold a company, right? So it's about more than money, because you can throw money at something, but it has to, you have to, the team has to be able to execute. Yeah. You have to be able to actually realize a market. And in Web3 and in crypto, it's interesting because we're either potentially building new markets, or we're trying to convert people over to a different way of doing things in the market, right? And so, for me, when I say it's about more than money, it truly is. And at Macroeconomic, we try and really be quite hands-on with what we do, because we don't believe that money is the only solution for building a company. So for us, the future is, you know, we're looking at our accelerator program over the next 12 to 18 months. That's really our focus, because we've seen the most success from that, and we believe that, you know, that if we put the work in to help founders to get where they need to go, then
you'll benefit both of you. Yeah.
Everybody will benefit.
Win-win.
Right.
Yeah. Also, Brandon, you're one of the earliest and largest VC firms in crypto as well. Did you face a first mover advantage, or was it more like, did you suffer from it because it was way too early?
Well, of course, nowadays everyone thinks we had a huge advantage from being first movers. But the truth was at the time, we were looked at as pretty crazy. I mean, our very first investment was Chainlink, and this was kind of back before smart contracts were even popularized via dApps. Of course, you know, we were positioned very advantageously and have grown immensely with the industry. And so now, you know, we're much more mature. And just to piggyback on Zia's point, definitely a believer in the future, not being capital driven. You know, in my view, capital is somewhat commoditized. It's frankly, you know, akin to any other industry. It's all about the people. And so, frankly, what we're looking for are just founders with commitment for 5+ years, 10+ years to an absolute mission, something that they have strong opinions about, something that they're willing to, you know, work with us on, be coached, but also lead the charge. And, you know, I love the hands-on sort of statement because that's something that we pride ourselves on. We have, you know, over 14 full-time engineers on staff, and we like to be lead investors. We like to have skin in the game. We're not writing, you know, small checks. We're writing concentrated, larger size checks in seed stage Series A rounds. And working with them, all of us on the venture side, our engineers work on a team called Labs. But in any case, you know, we're there to help our portfolio win. And that always boils down to the people.
Yeah, completely. Paula, so as a serial entrepreneur, you said your aim is to enable the transition to decentralized nations.
I don't remember saying that. I mean, as primarily I can say that I had always been an investor. I'm coming from traditional finance, or what crypto people like to call TradeFi, to sound more fly. And I think that as an investor, you're always part of especially being an early stage investor, being into venture capital, this gives you access to all the latest technologies, speaking to the best founders in the world. So I've been reviewing since the beginning of the year. I think that we have been looking at very, very interesting projects. And I think what surfaces into the market mainly, and what we're seeing, what gets really hyped, that was the previous speaker was talking about, is actually not the underlying technologies, not the foundation. And we're more into the infrastructure. So we come to see a lot of interesting technologies. And maybe that's something that I mentioned, that I love to be part of it and have even the smallest contribution, because as investors, especially as a venture capital firm, we don't deploy just capital, but we deploy all our resources. So once we invest into a company, we become also their advisors, connectors, and we just do everything possible to ride and die with our portfolio companies.
That's a common theme that we see in all of you. And most of the founders actually love that. I mean, they need that assistance, that support. Some of them don't, but most of them do. About the bear market then. So is this the first time that the bear market, the cryptos are facing since their appearance ever to this extent? Or have you seen something as dramatic as this before?
Drama's one thing. The bear market's another, right? So we've definitely seen a bear market. In fact, worse than this, if you kind of look at the metrics. But drama, I think the drama is more prevalent because the industry is more progressed, right? We have more eyes on us right now. We definitely had dramas back in, 2015. We had Mt. Gox. We've had dramas before. But it's more in the eyes. It's more, it's more in the media. We didn't have a crypto CEO on the cover of Forbes until, when was it, last year or the year before, right? We hadn't had that, or a CEO of a major kind of Web3 or crypto exchange. So we certainly have more eyes on us. And now, for me, it just comes with the the territory of a new technology. If you look back at the Industrial Revolution, you had rivals taking each other down all the time, right? It was a thing. And now we're in the same kind of, and I'm not saying we're in an industrial revolution, but we are in the grips of a new technology that I believe certainly has the opportunity to take over many, many industries. And so we're going to see this drama. It's just human nature. It's unfortunate. But.
So this is normal. This is just the nature of.
I mean, normal is an interesting word. I think it's
expected.
Expected, normal.
Somewhat.
I think when you have something as revolutionary as the technology that we have, honestly, underlying crypto, underlying everything else, right? I'm talking about the technology, because crypto isn't the technology, it's one application of it. I do think that you're going to have these kind of crazy events.
Okay,
Yeah.
Not surprising is the word.
No, not surprising. And I would say, it's reasonable to suggest that this is like other industries in their historical analogs. But the thing is that the time horizon is so compressed that it kind of catches people off guard. And we've been through multiple cycles, as an industry, everything from Mt. Gox to post-ICO era to Black Friday during COVID, where frankly it felt existential. And it was sort of like us looking around the room like, is crypto, are we just done? Are we canceled? Like, is this it? And, this time I would say that it's not any different in the sense that we will, rebound. But to Zia's point, we've never had so many eyes on us as an industry from, not just a regulatory perspective, but also the number of users, now probably the number of retail users who've lost capital via, the FTX fallout. And so it's same, but different, I would say. It's generally going to happen, but it's unfortunate. I think the silver lining is that it makes it clear that CeFi is not the answer, and custodying user assets is not the answer. At the end of the day, this is public-private key encryption technology, and folks should either custody themselves, or better yet, new companies should emerge with new encryption algorithms to generally, enhance things like MPC or multi-sigs or any number of new technologies where private keys are managed in just a much better way and assets are genuinely protected, because clearly that was not the case here. So.
Yeah. All
and
right.
that's the technology, right? Like, that's actually what we're here to build. We're not here to build centralized exchanges.
Yeah, no, exactly. And I think, the beauty of this is that the market weeds out the bad actors. Yeah. They are, usually capitalizing for a few years, but with every downturn, the market weeds them out. And I think that that's, a very positive thing.
Exactly, I perfectly agree with Brandon. Well, I think that the roots of the current market cycle are going a bit deeper, like we should go back to the COVID time. And I think that this is not just a crisis in the crypto sector. We see that also the equity markets are falling down, and it's very normal with the current monetary policy and increase of interest rates. So this was something expected, and I think that maybe the unexpected part, or something that we cannot learn from the history, is that our economy stayed closed for almost 2 years, depending on the region. So obviously this affected all the sectors, and with the change of monetary policies, this also affected the money supply. So as much as we love to believe that the blockchain sector is an inflation hedge, is a completely different industry, at the end of the day, it feeds from capital flow. And when there is less capital in the market, that's what happens. It starts drying out. And then when the volumes are lower, it's way easier to, let's not say manipulate, but it's way easier to move the market when the volumes are low. This is valid for any market, but blockchain is still very, very emerging sector. And the volumes are that low that if a big institution with even the average size of a capital firm, let's say in the US, enters the market, can really disrupt it or move the prices. And since it's an emerging sector, there are a lot of companies, and there is lack of regulation yet for the same reason. That is what happens. Like when they're weak companies, they just get out of the market one way or another. And that's what we're observing. But I feel that since Brandon mentioned also FTX, I feel that this is an event, this was like the last nail in the coffin. I feel that this will be something that will have long-term effect in the market.
Yeah,
because,
big time.
Yeah, because maybe if I can just add, I know I'm getting a bit longer, but I think that's important because there were few waves of retail users losing capital, losing cash, and sometimes losing all of their savings. So it went everything from Celsius through Luna, and now we are at the FTX stage, where another wave of people lost their capital. And these are people that probably would never come back to crypto. So we already lost these users. And then I think that we need to see more effort on the institutional side to bring more institutional capital in order for these markets to become more efficient. When I say more efficient is that when you have higher volumes, you have higher capital involved, it's way harder to move the price in such high terms.
And do you think in the eyes of the investors, does that make them lose their trust on cryptos? Or do you think, as Zia mentioned, this is a cycle that was meant to happen, we were expecting it, maybe not to this extent, but maybe institutions have positioned themselves more differently and the individuals maybe stepped back a little? How do you think the investors are eyeing the situation?
Well, I would generally say it depends on the institution. Unfortunately, I would say a certain cohort of them were investors in the very things that caused the crisis. And so I imagine they're not too pleased with themselves and their decisions. And they're likely going to have to be bearish just to protect their jobs.
Yeah.
But, broadly as a category, I think that many of them are realizing that this is important. And this is a real technology movement. And it's not just people on the internet swapping tokens and trading JPEGs of monkeys. And, we're having those conversations. The thing is, to think of it as something of a sales cycle, it's a relatively long cycle. Mm-hmm. But those conversations continue, progress continues. It's somewhat slower and in the background. You generally hear of these announcements, over the year, and sometimes they're covered, sometimes they're not. But no, that's very real and it's happening. But certainly for later stage investors, growth investors, I won't name names, but generally those investors have had a tough year of it. And so I wouldn't be surprised to see them pump the brakes and reassess.
Yeah.
Yeah, I think it's, to Brandon's point, I think institutional investors are going to have a little look at themselves. Some of them. I think what's unfortunate in our industry is obviously the exposure to retail investors, right? So retail investors, the barrier to entry versus traditional or TradFi is very low. Mm-hmm. So if you learn about crypto and you want to get into it, it's not that hard. You can do it, and in some ways, that can be detrimental because, of course, you have people who had exposure to these sorts of things. And I think that really, for retail investors, it's a hard lesson, but it's a good lesson. And that not your keys, not your crypto, this kind of thing is honestly, I was absolutely shocked at the amount of people that had exposure and left their money in an exchange. I was absolutely shocked. And not just your everyman, people that supposedly had been in the industry for a really long time. It was shocking. So I think, it's a hard lesson, but it's a good one, unfortunately. And I think, again, to Brandon's point, it actually exposes and realizes the technology underlying everything. It's important, and it's what people need to be really looking at, rather than this kind of entry into a financial market that you may not have that much maturity in, if that makes sense.
No, yeah, it was great quantum, that's for sure. Paula, anything you want to add?
Well, on a bit more positive note, as Brandon mentioned, it's a cycle. So I think I see this time as opportunity. But if we are looking at in terms of institutional investors, it really depends on how much of your capital you deployed. So I believe that funds that deployed the majority of their capital between, let's say, 2021, beginning of 2022, would be suffering greatly at the moment because the valuations dropped almost by 80%. And also the private, especially the private valuations, dropped big time. So if the average valuation in the sector for a seed round that we had been seeing was around, let's say, 60, 70 million, now for the same projects, the founders are struggling to raise at 15 to 20. But then on another hand, if you're a new firm, a new VC, then you have all the benefit because you're entering at the lowest point. And venture capital is all about the long term. So as a VC, you should be okay to lock your capital for 3 to 5 years. So from this point at the moment, as every cycle, I don't think any bull cycle continues forever, no bear cycle continues forever. So we are already at a very, very low point. So I really think that in 3 to 5 years, both overly the economy would be recovering, so the macroeconomic conditions will be way better, and also we'll be starting to go out of this bottom probably sometime next year. So I think that if right now any VCs, any companies investing early stage that have capital to deploy are in the very best position.
Just to elaborate on that, that was my next question actually, whether this is an opportunity or could it be like opportunistic pricing for you guys? How would you shift this around?
I think for us, onwards, we keep building. This is absolutely an opportunity. It's, to Brand's point earlier, it's kind of we're flushing out some of the bad actors. It's not a bad thing. Of course, and we're long-term investors, right? There are, and I guess this is a good point if there's any projects out there. There are investors that crop up every bull, VCs that crop up every bull run, that take advantage of the bull run. They're not real VCs in crypto. So, we are here for the long term, and we're here for the technology, and we think that it's an absolute opportunity to find those next kind of founders that are building the future, and that's what we truly believe. So, it's an opportunity, I think.
Yeah, 100% an opportunity. I mean, on a personal level, it makes my life easier that there's less noise and more signal. But on a professional front, a lot of people sort of have this, I would say, misconceived notion that VCs love lower valuations and they come in and just make all this money. And that's, frankly, not the truth. But what is true is that generally we find after events like these, founders are smarter, they're sharper. They know who they want on their cap table. They have a stronger conviction on their thesis. Those who don't have those things sort of self-filter and elect to go do other things, and that's totally fine. But for those who stick around or are just joining us, this is an excellent time to carve out your space, partner with the people that you think will help you, and execute on your mission. And so, for us, those are the folks that we want to chat with, that we want to meet, that we want to partner with. And, assuming you find those individuals, and we do, it's an excellent time to go to market, to build, to partner, because, like I said at the onset, it's a much quieter environment. It's still competitive, don't get me wrong, and nothing comes easy, but I would say it's generally easier to build in a bear than the absolute peak of a bull market.
Yeah, actually, that's something I wanted to add as opportunity. It's very interesting, the shift in the deal flow that we're seeing from the beginning of the year. So right now, I think everybody realized that we're lacking a bit the foundation. So we're lacking infrastructure. So whatever you build as a top player can never be successful as long as you don't have the infrastructure itself. So that's mostly the deals now. It's going way more slowly than it was during the bull cycle. So if before we were reviewing, let's say, 5 projects per day, now we're reviewing maybe, I don't know, 5 per week. But the quality of those 5 per week is uncomparable. And since there was this huge market hype in the beginning of the year, it was like ridiculous, first the number of projects we're receiving, and actually those projects were receiving capital from very established names in the industry. Which is the craziest part. And then we were reviewing everything, like from metaverses, that they haven't built anything, but they have the perfect idea. You know, they have so much to say, but actually when you ask them for a demo, they have just the pitch deck. Or like people that are, like guys are tokenizing chairs, tokenizing tables, anything. And that's the normal cycle. And now we don't see those anymore. We're seeing a very value-add deals. And that's what we're focusing on, by the way. In the first half of the year, we were not so much sector agnostic, and right now we're focusing mainly on DeFi. We're also looking a bit into infrastructure, but we think that DeFi is the next big trend, especially at that early stage.
It's not only the VCs or the founders, but the ecosystem itself as well, like the regulators, the market everyone's gonna like shake up a little and relook at themselves.
There's less distraction, so the mission and the focus is on, well, I think the core values of what we're trying to do. So yeah, I mean, distraction during a bull, it's so distracting for founders because it's constantly, like, especially if they're tokenized, right? Like it's like the token's doing this, so there's less distraction, right? And that's quite important for everybody, because sometimes, you know, the market is a distraction, whereas if you've got no market or the market's down, you have to focus on the core missions. Mm-hmm. Yeah.
And when do you think the markets will normalize, go back to normal? Anyone? Maybe we can hear from the audience as well.
Well, this is not financial advice, but I generally hold a view that gaming is going to really help this industry beginning next year. There are dozens and dozens, if not hundreds of titles set to launch next year over the course of the entire year, you know, starting out with fast casuals and rolling through different genres to AAAs. But broadly, I view all of these as huge opportunities and shots on goal to onboard, like we see in mobile casual, for example, hundreds of millions of users. And it won't be, you know, Axie Infinity, token inflation driven, play to earn. Maybe some of those take off, good luck. I'm not necessarily betting on those. But frankly, it'll be more of the games that we're all accustomed to, but now with digital ownership over our collectibles. And so I do think that that'll be a major catalyst. Ethereum as well is going into a deflationary environment. And so we're watching that very closely and are very bullish there. But, you know, capital generally reshuffles to the best assets. And so, you know, I don't think the capital is necessarily leaving. It'll just reshuffle itself. And those are two of the catalysts that, you know, I'm paying the most attention to, gaming and Ethereum.
While I agree on the timeline, I think the catalyst will be different, at least from my perspective. As I said, no trend continues forever. So after any big cycle, I think the market needs a bit of time to calm down. And once this period is over, I see the catalyst and the institutional adoption. And there are very big news happening, but unfortunately, they were overshined like by all the bad news happening. So I think that Fidelity just announced a week ago that they're launching a crypto platform. And this is one of the biggest traditional names in the industry with huge amount of customers and huge amount of AUM actually. So Fidelity, BlackRock partnered with Coinbase earlier this year to provide institutional custody for Bitcoin and Ether. So I think that all those institutional money are just right now parked, and they're a bit scared to deploy anywhere. I don't think that any of the funds are very active in the equity markets as well. I think everything's slowed down right now globally, economically wise, but I think that sometime early next year, things will start shaking up a bit, and once we have some confirmation of some potential reversal, then all those institutional players will come into the play. And I believe that would be the catalyst. Again, that's not a financial advice, but as I'm saying, like nothing continues forever. So I see the light at the end of the tunnel. And at the end of the day, over any crisis, the sector never disappears. That's something that we learned from the dot-com bubble. Like a lot of people lost money, they were very upset with it, but actually few big companies emerged out of it. Amazon emerged out of it. So now I believe that if until today there were, let's say, 5 top names in the industry, in the next 2 years, those names will change, that's all. But definitely there will be upside.
Yeah, just to add for a moment, because I think that's such an important point, is, the institutions are generally lined up and ready to roll, but it's the regulation that needs to lay the groundwork. And so, while I'm hesitant to bet on any timeline with regulators, I do think events like this generally shorten the timeline. And so that's a very good point.
Yeah, I mean, I kind of agree with both of you, and the convergence of both. Gaming, I think, is really interesting because, we're going to touch this technology without realizing it in many ways, and that's what I think needs to happen. And gaming's, I think, a really perfect example of that. I am of the opinion that if you're talking about a bull run, I don't think we're going to see that until 2024. And one of the reasons is my theory or my thesis on technologies around 10-year maturity levels. So we're NFTs 2014, 2024 is when we start to see the real use cases of something. So yeah, the 2024.
What did you say? 2024?
Right. Yeah, sounds interesting, right? Okay, so NFTs technically the first NFT was minted in 2014. And my thesis on technologies is they usually take about 10 years to mature in terms of being able to see real value. And I'll be honest, it hasn't been wrong so far. So my theory is NFTs in gaming, however they're used, 2024 is when we'll see the real value in those. But that's, again, not financial advice, but that's my theory on it. And so yeah. But institutions, very important point. And I think also we're quietly seeing lots of brands come into the space, lots of corporates come into the space, quietly in this sort of period, and I think we'll start to realize that next year. We'll start to realize what they're doing. And
also, mind you, I mean, the cryptos are only a little part of the entire blockchain or NFT, as you said, NFTs, DeFis. I mean, there's a lot more aspects that you can compensate with.
Yeah, cryptos is one use of a particular technology, but it's not the only one.
Yeah. Okay, last 2 minutes. Any advices to the founders who are sitting today with us?
Prepare.
Yeah.
Excuse me. I would say prepare. And what I mean by that is, don't expect to win the world over with a white paper and ideas anymore. Build something, show something, and, have opinions, have strong opinions, have a thesis. Have line of sight to the resources that you need to accomplish your mission. That's the main thing that I look for, is people who've shown up and clearly indicated the level to which they're prepared to pursue this for not just 1 or 2 or 3 or 4 or even 5 years, but build a career out of it. And, not just look for a quick and easy exit, but build a lasting company. And so that's my bias, and that's my advice generally to anyone.
I think also, you know, company is a good word, because I'm really sick of hearing project. Because if you're building something, it's not it shouldn't be a project, it should be a company. It should be something that you're building for the long term. A project is a experiment, in my opinion, right?
Well, for venture-backed, but we want projects and generally ecosystem stuff as well,
Yes.
just to be clear. But yes, for investors.
Yeah, for investors, you know, you want you know, we see a lot of in crypto and Web3, we see a lot of projects that spin up white papers, you know. Building is the most important thing. Shipping and building, even if it's, you know, doesn't look great, get it out there, because you know.
Courage.
Yeah,
Just
you
to
can
do
iterate, you can do, you know, and this is, it kind of goes back to venture times, you know, past. It's, in traditional venture, it's build it and it's test it, and, you know, those fundamentals, they apply to Web3. Like, it's okay
I
to
think
be
since we're over time, I'll be super short on it, but I really want to give that advice, because a lot of founders that are also friends they don't understand why they get rejected by VCs. So I want to share the main metrics that we're looking at. So the first one is having traction. During the bull market, a lot of firms were getting funding easily, but right now all the VCs are looking for traction. So if you have your own project, try to bootstrap it until you have any proof of concept, like that actually users want to use this, and then go to the VCs. You're going to have way better terms to negotiate, and it will be way easier to also get investors in, because if you're just on idea stage, there's some VCs that are doing such investments, but first the terms will be terrible for you, and second, the amount will be really small, so you end up again bootstrapping until the next round. So that's, I have a lot more, but that's my top advice.
Perfect. Any questions from the audiences? Please. I don't know if there's a mic, but we can hear you. We'll be able to hear you.
See, there is one of the reasons why we see that these projects, which involve different types of investing besides from TradeFi, have not been able to do so well, or there is a lack of confidence with the investors, is simply because there is an absence of regulations.
Yeah.
Now, you see, this is an important question that one cannot overrule. Now, if you want to provide financial services through automated software protocols, you call it DeFi, then you need to be regulated. Let me tell you about what is happening in my jurisdiction. I live in Dubai and Abu Dhabi. There is Dubai International Financial Center and Abu Dhabi General Markets. Abu Dhabi General Markets published a consultation paper and asked all the concerned parties to say how we can develop a mechanism whereby DeFi can be provided through this institutional structure. Now, these laws, we also submitted, my law firm also submitted its opinion. I work for Emirates Legal. We have submitted our opinion and we are actively participating. So, what is happening in Dubai and what is happening in Abu Dhabi cannot be ignored at this point in time. And this should be, and the importance of regulations having be there is what will bring the confidence back. I feel there's something going to happen on 15th of January. All these new legislation is already there, but it will become effective. So what is going to happen? There's going to be a rush from all the VC funds moving into this jurisdiction and getting themselves registered. And also to Paula's question about advice to the founders, you see what they are doing is they have a fintech hive kind of a place there. Yeah. So they are testing their product for 1 year or two. And all these investors are waiting and looking at how this product is being used. And the funding comes immediately there. So all this is happening, but it is not happening at the scale at which it should. So that's all I wanted to bring to your attention.
Yeah, thank you. I guess the reason why we haven't mentioned much of the regulation is because it's out of our hands, you know. Hopefully, as you said, there'll be a more optimistic picture once the regulation steps in. Will definitely, with more governance and transparency, that's we need in the Web3 scene. But hopefully the regulators will step up. Thank you so much. And many more questions, but we ran out of time. That's okay? No questions. Okay, I'm sorry, no questions, but you can definitely take them outside with our panelists. Thank you for listening to us and joining us. Thank you.
Thank you.
Thank you.
Thanks so much.